On January 29th, 2026, silver did something that nobody alive had ever seen before. It hit $121.67 per ounce, shattering a 45-year-old all-time record in one of the most violent, breathtaking rallies in modern commodity market history. One day later, it crashed 31% in a single session, the worst single-day wipeout since March 1980. $7 trillion vanished from global markets in 2 trading days. And right now, in late February 2026, silver is trading back near $93 per ounce, having recovered most of those crash losses. And the debate raging across every trading desk and investor forum on the planet is, was January's spike the peak of a bubble, or was it just the opening act of something much, much bigger? Today we are going to answer that question with real data, fresh data. We are going to break down exactly why silver hit that historic record, what triggered the most violent precious metals crash in 40 years, and where this market is headed next. Let's get into it. Section 1. The 45-year record that finally broke. To understand January 2026, you have to go back to January 1980. The previous all-time high for silver was $49.95 per ounce, set during one of the most extraordinary episodes in financial history. 2 Texas oil billionaires, Nelson and William Hunt, attempted to literally corner the global silver market. Starting in 1971, they accumulated physical silver and futures contracts on a massive scale, taking the price from $1.50 per ounce all the way to nearly $50. Their scheme drove the biggest short squeeze in silver's history. But in January 1980, the COMEX exchange stepped in and implemented what became known as Silver Rule 7, restricting leveraged buying of silver futures. The Hunt brothers' positions collapsed, silver crashed 80%, and that $49.95 mark stood untouched for 45 years. In 2011, silver tried to challenge it during a commodities supercycle, reaching $48.70 in April before collapsing sharply again. 2 attempts, 2 failures at $50. Then 2025 arrived and everything changed. Silver broke through $50 for the very first time on October 9, 2025. Unlike the previous 2 attempts, it didn't collapse back. It held above 50, consolidated, and kept marching higher. By December 2025, silver was trading in the $60 range. By mid-January 2026, it had crossed $80, then $90, then $100, another historic first. And on January 29, 2026, silver hit $121.67 per ounce, setting an all-time nominal high in the metal's recorded history. In 12 months, silver had surged from around $30 to over $120, a gain of roughly 280% at its peak. The 45-year ceiling wasn't just broken, it was obliterated. Section 2. 6 reasons silver exploded to $121. So what exactly drove silver to levels no living investor had ever seen? There wasn't one reason. There were 6 major forces that converged in a perfect storm. And when you understand each one, the January rally stops looking like a fluke and starts looking almost inevitable. The first force was industrial demand that broke all records. Silver is a critical industrial metal, and in 2024 and 2025, demand was absolutely off the charts. Solar panel manufacturing alone consumed 244 million ounces of silver in 2024, more than double solar demand from 4 years earlier. Electric vehicle production drove a 20% jump in EV-related silver demand during 2025. And then came a brand new demand source that nobody had fully priced in: artificial intelligence. AI data centers and high-performance computing infrastructure require enormous quantities of silver for semiconductor manufacturing, precision electrical contacts, and thermal management. Silver's recognition by the U.S. Department of the Interior as a critical mineral in 2025, alongside lithium, cobalt, and rare earths, officially cemented its strategic status. The second force was China. Chinese institutional and retail investors launched a powerful and sustained silver buying campaign throughout 2025 and into early 2026. Citigroup's analysts called it relentless, describing silver as, and I am paraphrasing here, gold on steroids, driven by Chinese momentum that showed no signs of slowing. And then on January 1, 2026, China implemented a new export licensing system for silver that severely restricted physical silver flows to international markets. China is the world's largest silver producer. When China effectively tightened the export tap, global supply chains were disrupted overnight, triggering panic buying from industrial users who needed guaranteed physical supply. The third force was the 6-year supply deficit. The silver market had been in a structural supply shortfall for 5 straight years entering 2026. Global demand was running at over 1.2 billion ounces per year, while mine production was stuck near 813 million ounces annually, and flat for years. COMEX registered silver inventories fell below 100 million ounces for the first time on record. Physical silver was genuinely becoming scarce, and markets were starting to price in that scarcity. The fourth force was safe haven demand. The start of 2026 was geopolitically chaotic. Tensions between the US and Iran were escalating. Venezuela faced renewed political instability. Japan was navigating domestic political unrest alongside China tensions. The World Bank and OECD both revised global 2026 growth forecasts downward, warning of slowing demand and tightening financial conditions. Investors fled to safety, and in this environment, both gold and silver captured enormous safe haven flows. Gold hit its own all-time high of $5,626 per ounce on January 29th, the same day silver peaked. The fifth force was the weak dollar and rate cut expectations. Through late 2025 and early 2026, the US dollar had been falling steadily as markets expected the Federal Reserve to cut rates aggressively throughout 2026. A weak dollar is rocket fuel for metals priced in dollars. It makes silver cheaper for global buyers, increasing demand. At the same time, precious metals benefit from lower interest rates because they become more attractive relative to yield-bearing assets like bonds. The sixth force was massive investment inflows. Silver exchange-traded products recorded net inflows of 95 million ounces in just the first half of 2025. By January 2026, ETF and institutional positioning in silver had reached levels not seen in years. All 6 of these forces hit simultaneously in the last week of January 2026. Silver jumped from $89 on January 22nd to $121.67 in just 7 trading days. A 37% surge in less than 2 weeks. Historic. Section 3. The crash. What actually happened on January 31st? 7:30 to 10 o'clock. And then January 31st, 2026 happened, and it was catastrophic. Silver crashed 27 to 31% in a single trading session, its worst day since March 1980's Hunt Brothers collapse. Gold dropped 11%. $7 trillion in global market value evaporated in 48 hours. Bloomberg called it the last 2 days of carnage. What actually caused this? There were 4 simultaneous triggers that created a cascade of forced selling, and understanding them matters because the same dynamics could play out again. Trigger number 1, the Warsh shock. On the evening of January 30th, President Trump nominated former Federal Reserve Governor Kevin Warsh to succeed Jerome Powell as Fed chair when Powell's term ends in May 2026. Warsh is widely known as a monetary hawk. He famously resigned from the Fed in 2011 in protest of quantitative easing, warning that it would distort markets and inflate asset prices. His nomination was immediately read as a signal that the Fed would remain restrictive for longer than expected. No aggressive rate cuts, possibly even tighter monetary policy. That single announcement torpedoed the core thesis that had been driving silver higher. Everything that had been priced in, a dovish Fed, a weaker dollar, aggressive easing, was suddenly in question. Algorithmic trading systems immediately triggered sell orders across the SPDR Gold ETF, the iShares Silver Trust, and precious metals futures. The dollar spiked. Yields rose. Silver's safe haven and monetary thesis was abruptly repriced. Trigger number 2, CME margin hikes. CME Group, which runs the COMEX where silver futures trade, had already raised initial margin requirements for silver futures to $25,000 per contract in late December 2025. Then, on January 30th, they raised margin parameters again from 11% to 15%. Traders using leverage, and many were, after a 300% rally, were suddenly required to post significantly more capital or liquidate their positions immediately. Most chose to sell. Trigger number 3, Shanghai crackdown. Chinese regulatory authorities moved simultaneously to halt subscriptions in certain commodity fund products linked to silver, including the UBS SDIC Silver Futures Fund, removing a key source of demand from the market at the exact moment it needed support most. Trigger number 4. Profit-taking cascade. After a 280% rally from January 2025 to January 2026, millions of investors were sitting on extraordinary paper gains. The initial sell-off triggered stop-loss orders, which triggered margin calls, which triggered more forced selling. A classic cascade where the selling feeds on itself. The options market also played a role. Dealers who had hedged large call options were forced to unwind those hedges as prices fell, adding further downward pressure. The result? Silver fell from $121 all the way to $77 in less than 48 hours. The worst short-term precious metals collapse since the Hunt Brothers era. Section 4. Where silver stands today. So where does silver stand right now, on February 28, 2026? After the brutal crash to near $77 in early February, silver has staged a remarkable recovery. The metal is now trading around $93 to $94 per ounce, approximately 22% below the all-time high, but dramatically recovered from the February lows. Year over year, silver is still up over 180%. Year to date in 2026, silver is up roughly 30%, even after the crash and recovery. Technically, the picture is constructive. Silver broke out of the symmetrical consolidation triangle that capped February's price action, reclaiming the $90 level. The RSI momentum indicator is trending back above 50, which signals that bullish momentum is rebuilding after the shock. Key upside targets the market is watching: $95.90, then $102, then $112.50, and ultimately a full retest of the $121.67 all-time high. Key support on any pullback: $86, the 38.2% Fibonacci retracement, and then the 50-day moving average. The gold-to-silver ratio is currently sitting around 50 to 1. In April 2025, it was above 100 to 1. The compression from 100 to 50 over 9 months tells you how aggressively the market has been repricing silver's relative value versus gold. The fundamental picture has evolved since January's peak. The Silver Institute confirmed a 6th straight year of supply deficit. Industrial fabrication is projected to ease slightly in 2026, by about 2%, as solar manufacturers find modest efficiency gains in silver usage per panel. But physical investment demand is forecast to surge 20% to a 3-year high, as Western investors who missed the 2025 rally re-enter the market following silver's historic performance. Section 5. What happens next? 3 scenarios. Now for the question everyone wants answered. What happens next? Here are the 3 real scenarios based on current data and analyst forecasts. Scenario 1. The bull case. Silver retests and breaks the all-time high. This is the scenario the structural bulls are betting on. The supply deficit is entering its 7th year. COMEX inventories remain at historic lows. Solar, AI, and EV industrial demand continues growing faster than mine supply can respond. The dollar remains under pressure, and the gold-to-silver ratio at 50 to 1 still looks historically cheap compared to the 40 to 1 ratio seen during peak bull markets. Citigroup's commodities team, citing strong Chinese buying, supply constraints, and structural imbalances, put out one of the most aggressive near-term outlooks on the street, projecting silver could reach $150 per ounce by mid-2026. BNP Paribas has also flagged $100 as a realistic target for 2026. The inflation-adjusted argument adds further weight. The 1980 silver high of $49.95, adjusted for today's dollars, equals approximately $194 per ounce. Silver at $121 is still below its real inflation-adjusted all-time record from 45 years ago. For long-term bulls, that gap represents enormous upside. Scenario 2. The bear case, extended consolidation or deeper correction. This scenario hinges on Kevin Warsh. If the new Fed chair pursues genuine monetary tightening, raising rates, shrinking the balance sheet, resisting political pressure for cuts, the dollar strengthens, and the rate cut thesis that drove the silver rally evaporates. A global economic slowdown, particularly in China, could simultaneously reduce industrial demand and investment appetite. COMEX speculative positioning data from the CFTC shows that managed money net longs in silver have already been cut to their lowest levels since February 2024, meaning speculative excess has been largely purged. The most pessimistic institutional forecast for end-of-year 2026 comes from UBS at $85 per ounce. Commerce Bank sees a mid-year floor around $92. These are not catastrophic numbers. They suggest consolidation rather than collapse, but they imply silver will struggle to retest 121 in the near term. Scenario 3. The wild card, a physical delivery squeeze. This is the scenario that keeps sophisticated silver market observers up at night. COMEX registered silver inventories are below 100 million ounces, a multi-decade low. If industrial users, ETF investors, and foreign central banks all simultaneously demand physical delivery of silver, and mine supply and above-ground stocks cannot meet that demand, the paper futures market faces an existential stress test. In a genuine delivery squeeze, prices could move to levels that currently seem inconceivable, and the regulatory mechanisms that existed in 1980 to stop the Hunt brothers may not be available in the same form today. This is a tail risk scenario, not a base case, but it is a real possibility, and it is why the most extreme silver price forecasts, the ones ranging from $200 to beyond, are taken more seriously today than at any point in decades. The data-based base case for 2026. Silver is most likely to trade in a broad range of $85 to $120, with direction determined primarily by three variables: the pace of Warsh's confirmation and his actual policy actions, the trajectory of Chinese economic demand, and whether physical silver inventories continue to deplete. Closing. Here is the bottom line. Silver hit $121 in January 2026 because six massive forces converged at the exact same moment: record industrial demand, China's export restrictions, a 6-year supply deficit, safe haven flows, a weak dollar, and explosive investor inflows. The crash that followed wasn't about fundamentals breaking down. It was about leverage, margin calls, and a single political announcement, the Warsh nomination, that repriced monetary policy expectations in a matter of hours. The structural story for silver remains fully intact. A sixth consecutive year of supply deficit, inventories at historic lows, the fastest growing demand sources in silver's history, AI, solar, and EVs, still hungry for the metal, and a gold-to-silver ratio that, even at 50 to 1, suggests silver still has significant room to outperform on a relative basis. Whether silver's next stop is $85 or $150 depends on decisions being made in Washington and Beijing right now. But what is not in doubt is that silver in 2026 is a fundamentally different market than silver in 2020, or 2015, or 2010. The metal has been repriced. The 45-year ceiling is permanently gone, and the forces that drove this repricing are still accelerating. The January spike was violent. The crash was brutal. But in the long arc of silver's history, we may look back on both events as early chapters in a much larger story. Keep watching, stay informed, and as always, do your own research and speak with a licensed advisor before making any investment decisions. If this breakdown was useful, hit like, subscribe for weekly updates, and drop your silver price target for 2026 in the comments. See you in the next one.